And I would kindly ask Dr. Martin Stopford to come. I'd like to say a special thank you to him for honoring us with his presence and contribution every year. And Martin has come with us to Athens, to Cyprus, to Singapore. So thank you for your friendship and support. We are gratified and honored to have you here with us every year. Thank you.
Oh, thank you, Nicholas.
Thank you.
Yeah, well, it's always a real pleasure to be. This is an interesting time, you know, the autumn, you come back from our holidays, you're wondering where the market's going, and it's always wonderful if you can come along with a really positive, invigorating message about the future of the markets. Needless to say, I'm not going to do that this morning. I took a look at it. I mean, I don't do quite so many markets, sort of blow-by-blow market forecasts or analyses as I used to. And so I found that's quite good. I come back to the market after 2 or 3 months and you have a look at it, and it, of course, you know, I've been doing this slot for a few years, and you look back at what you were saying, say 2 years ago, I think I was pretty sure we were past the trough. It was so bad that it had to be the trough, you know. I mean, and I think there was a good punt that things would get better. But now we have a more complicated situation, and what I'm going to do in the few minutes I've got this morning is, first of all, I'm going to give you a quick preview of what I'm going to say, so that because I haven't had quite time to sort of get my slides down to a manageable number, so I might sort of miss the last one, you know. So I'll give you an overview at the beginning, and then I'll look at a quick canter through the market cycle by sector. I don't really tend to cover everything properly, because you have so many people. When I've sat through these sessions, you have people who really are right in the nitty-gritty of the markets, and you'll have a lot of detailed stuff today. So all I want to do is just give you a quick sort of, you know, sort of top-down look at where the different sectors are. Something that's been, I mean, I would say as I wander around the world, sulfur never goes away. I mean, it really bothers everybody. I think people just, you know, nobody's quite sure what is the right thing to do, and the sort of do nothing seems to have been the default strategy, I think. But I have a few thoughts about, I think the issue in my mind is who actually is going to pay for, if you do go for compliant fuels, which is pretty well what the market's doing by default at the moment. I mean, out of 60,000 cargo ships, there's about 1,000 fitted scrubbers. So we're into, you know, at this stage, we're into compliant fuels, like it or not. And so then I think the next thing to think about is who's going to pay for the compliant fuels. So I got a word or two about that. Second-hand prices, of course, ship demand, sanctions and tariffs. Nicholas asked me to say something about sanctions and tariffs. And in fact, we were at a very interesting seminar at CAS yesterday with the 2 hotshot economists from the States who won the Onassis Prize this year for sort of reworking Ricardo's theory of comparative advantage. And in fact, after this, we're going back to continue that discussion and relate it to what Mr. Trump's up to, which would be quite interesting. See what their multi-dimensional model says. Yeah, I mean, this is a model where you can have as many various, you know, tens of thousands of variables if you want. The supply side of the market, it's not a very good story, and I'll tell you that. I'm a bit disappointed there. And finish off with a rough look at the supply-demand analysis if I actually get there. So that's the agenda. The overview, I think we did pass the trough of this recession a couple of years ago. We've been getting better. The problem is I've found it very difficult running through the numbers to really see enough momentum to carry us on a wave out of the cycle, as perhaps we've seen once or twice before. It's not unfamiliar territory for the shipping market, you know, and I think shipping market backed up by fairly cheap credit and none of the nasty things we have, foreclosures to quite the same extent we saw in the 80s. And so let me just quickly run through The Clarkson index is now about $12,000 a day. The really bad level is 9,500. It very rarely has gone down below 9,500 for more than a week or two. So I think we're in positive territory, and with the sort of cost structure of ships as they are today, this is not famine. It's not terribly generous, but it's not that bad. The world business cycle, as far as I can see, it's sort of I always follow the industrial cycle. The last 3 or 4 months, it started to edge over the top. So I do running 12-month averages, and that average has started to come down. I'll show you the graph in a minute, which suggests, I think, that we're on the move. The best we had last year, really. Trade, same sort of story. It grew 4.2% in 2007. Looks like this year it's going to be 3%. Good growth. On a trend basis, not bad growth at all, but we need really, to get into a good market, we need a bit more than that, is my feeling. And asset values are sluggish. The new buildings are up a bit, but the new building brokers tell me it's mostly steel costs and things, that it's not real, genuine asset price inflation in that sense. The China imports are still growing quite well, but there's something up there. I'll come back to that later. There are signals, I think, which, well, I won't come back to it later. When the China boom started in the early 2000s, we started to buy Chinese customs statistics, which were pretty good and very detailed. Since February, we haven't had any data at all from China on customs statistics. And in my experience, it's just like when the shipyards stop publishing prices, there's something funny going on, i.e. they're probably discounting behind the scenes and all that sort of thing. So there you go. The shipyard order book edged up a little bit. 10% is not a disaster, but it's more than the 9.5% we had 6 months ago. More bulkers in the order book. Deliveries have slipped 20% from 100 million deadweight to 80 million deadweight. At the peak, it was 160, so we're down, but the peak was ludicrous. 100 was pretty rich. 80 is not as good as 60, I would say. That's the way it goes. And there's tankers, there's bulkers in there. Fleet growth in 2018, about 2.6%, and the trade's growing at 3%, and we got about 20% surplus hidden away. I'm going to finish off with something about that surplus, because the surplus is not quite the same surplus we've had in the past. And then the bottom line, I think we're at risk of getting stuck in a rut. It doesn't have to happen, but it's looking a bit sluggish. That's the bottom line. So that's the sort of pitch. Let me quickly run you through the slides, and you'll forgive me for doing it quite quickly, because I have there's an enormous screen here telling me how many minutes I got left. No, please. I'll do it in 12 minutes and 6 seconds, Nicholas. Well, anyway, here's the Clarkson index. Looks a bit like the 90s. The 90s, it wasn't destitution, but it was boring, It went up a bit, it was down a bit. You had a dry bulk boom in 1995, and it lasted the summer, and that was it, And then we had a tanker boom in 97, and that lasted the summer as well. So here we are wandering along. The tankers are actually 16% below. If you take the last 12 months as an average of the last 7 years, then the tankers are 16% below trend, the bulkers are 15% above trend. Like all averages, this depends what the base is. The bulkers have had a pretty miserable last 7 years. The tankers had a nice boom a couple of years in 2015. So that pushed their average up, and it means that they're looking worse than they are. In fact, the two are sort of level pegging a little bit, I would say, at the moment. Containers, close on balance. That's in the charter market. Gas is really taking a hit after quite a good run. Offshore, that's LPG, of course. Offshore's still down. Chemicals, sort of, you never quite, they're a little bit under trend. I'm not sure how significant that is, but here's the tankers, which had a nice boom in 2015. I couldn't quite figure out why this happened, because we had on paper about 20% surplus in the tanker market. I think it was arbitrage on bunkers. I'll show you the slide later, but fundamentally, because I used to say to Paddy Rogers, how do you do this when there's a great surplus? And he said, what surplus? Well, I mean, but that was just Paddy's word. He's not here, is he? No. Hi, Paddy. But you see that, and I think now that the market has, sort of bounced back in the opposite direction, I think that convinces me that it was more an arbitrage on a very big cycle in the bunker market, because a lot of this stuff's traded in world scale. And there wasn't a boom in world scale rate, basically. There was a boom in the earnings. The bulkers, it's not been a good spell, and there's a bit more money around than there was. The average is up, for 3-month average, is up to $11,600 a day, which is not bad, and it's better than the tankers, which are pretty poor at the moment. The containers, about $8,000 a day. It's not really, it's not done much. The gas had a good spell, which the market deserved. That's bounced down again, but it always has. LPG always has been a very volatile market. The question of the bunkers and who pays for them, and this boom in tankers, I thought was worth making, because people agonized over compliant fuel or not compliant fuel, and I guess the big worry in everyone's mind is they're going to get stiffed on the cost of this stuff when we get to January 2020. There'll be shortages, and I mean, leaving aside the problems of loading compliant fuel and what happens when you get to the if you do non-compliant fuel because it's not available, and then you get to a port where compliant's available, and what you're supposed to do then. The IMO is supposed to be issuing its guidelines in January. It seems like there's still lots of discussion going on there. But I think the first thing I would say is, what's so different about 2021 in terms of the cost of your bunkers? I mean, look, this is the Rotterdam 380 CST price for bunkers, and it goes up, and I mean, it has been very heroic. It was up at $800 in January 11, and it's down at, then it was down to 140, 150, and I think that the question, that didn't really bother people because the charterer pays. That's the way the ship gets broked on world scale, and that includes your bunker cost. Is that going to be different for the sulfur? Well, the first point I just wanted to make on this arbitrage on the tankers was that this is VLCC spot earnings, is the red line in $1,000 a day. The blue is the chart you just saw on bunker prices, and that boom. It's this bit here. This is the tanker boom, and it exactly correlates with the collapse of bunker prices, and that makes me suspicious that the rise in earnings are due to the fact that, in fact, the market sort of carried on fixing at world scale rates and took a big arbitrage on the falling bunker prices. And because as the bunker prices went up again, the markets came down. And if you, that's the bit there, I forgot to put that in. And if you look at the world scale, that's the world scale rate for the major VLCC routes. And there isn't a big boom in there, really. So I think it's some food for thought about how that gets managed. Obviously, the charterer doesn't always pay. Sometimes the charterer actually gets on the wrong end of the deal. And so I think, as well as worrying about whether you should have put in those big tin cans in your ship to make it compliant. The other thing to think about is to talk to your broker about what is going to happen. And I don't know what the world scale panel is going to do on the first when they do the January 2020 world scale rate. I suppose they'll do several rates, but maybe someone here knows the answer to that. I haven't researched it. I just wanted to leave that thought with you. I'm running a bit of short time, so I'm going to get on with it. Prices. So there's, I mean, it's basically the tankers did well in the little boom. So they are very market responsive. The bulkers did badly. The two are pretty well back in sync at the moment. And this is, to make it a bit more graphic, those were indices. This is an Aframax on the right-hand side, a Panamax on the left-hand axis. And today, you know, the interesting thing is these prices are very similar to the 90s. They're just sort of marking time. There's nothing wrong with these as asset prices. They're not a million miles from replacement cost in terms of new ships. So they're not sort of like a balance sheet disaster, but they, and I guess you could say there's a bit of arbitrage in there, which is quite nice for asset players. But it's a pretty steady situation, not pushing one way or the other, just this sort of, you know, we're just marking time. World economy, we had a very nice run up from here along the last 3 years from 16. That's sort of turned down now. I think probably my sense is that it's very hard to disentangle trade effects. This sort of trade war that's going on, because you've got price elasticity as well. Some things you really can't manage without, and people will trade them anyway. You've got some big things like the soybean trade, etc. But in a sense, these do tend to get a bit lost in the overall trading picture, which is so enormous. And the drivers tend to be the macro stuff in world industrial production. And so really what I'm watching very closely in the next 6 months is whether this is heading down. And of course, there's quite a lot of sentiment around saying, well, it's 10 years. What with Lehman Brothers anniversary, it's 10 years since we really had a decent crisis, you know, which you've got to admit was a pretty good one. And so maybe there's something lurking out there. It's no more than supposition, but it's just they tend to turn up every 7 to 10 years. And so I think at the moment, it's something to be a little bit cautious about in terms of leverage. And of course, there's the interest rate rise lurking in the background as well, which, you know, I know we've been waiting for a bit of time, but that is another possible consequence of what's going on in the States in a year or two. But I'm sure you'll have others more qualified than me to talk about that, the crises. Seaborne trade, about 3%. Nothing wrong with that, except that the fleet's growing about the same rate. The dry bulk is doing a little bit better than tankers, which is, you know, in this year, don't see an awful lot of growth on the tanker side, and a little bit, you know, a couple of percent growth for the bulkers. China is, it's not been growing for the last 5 years. It's not been growing as well as you would expect, and it's still very, as perhaps what we're used to, it's still very dominated by the iron ore. It's, I mean, coal's gone down. In the last 3 years, coal's gone down a bit, iron ore's gone up. And in fact, one of the ones which is really quite revealing, I think, is the growth of China's exports. And I would have loved to have seen what's happened so far this year. This is exports of containerizable commodities. It's not container cargo, it's commodities which the guys at Clarkson Research have been through every commodity in the Chinese exports and said which of these are containerizable. And they end up with about 1 to 2% growth since 2014, which, you know, given that this is the heroic trade of the container business, you know, forget Mr. Trump. This is something this is a trend that's been going on for a bit, and I think it fits in with the whole, if you look at the whole macroeconomic scenario, this is what people are concerned about. And what Mr. Trump is, I guess, concerned about is the fact that nearly everything we have at the moment comes from China. Or you look around your desk and everything came from China. It's all beautiful quality. And that's fine, but it's a little bit unbalanced, you know. I mean, I love the stuff they do, but it's, you know, it's not healthy for a world economy for one country to make everything, you know. So you have, it's natural that you get a bounce back at some stage. On the supply side, as I say, we peaked in terms of deliveries in 2010-11 at about 160 million tons deadweight. We went to a plateau where we were for about 5 years at 100. It's now come down to 80. I think when I was here 2 years ago, I think the slide would probably have had us heading down for 60 at this stage. That is more comfortable. 80 still really leaves the fleet growing and marking time in terms of underlying surplus. Demolition, pretty steady at about 35 million deadweight. So you've got 80 deliveries, 35 demolition, you know. So there's your fleet growth. And here it is, the fleet. This is the fleet growth in percent per annum on this axis. This is the fleet itself in tons on that axis. You know, it's hovering around 3 to 4% at the moment. And the balance of supply-demand. I think in a forum like this, I mean, where you are concerned with capital and asset values, a thing that's happened in the last 10 years is this is the 1-year time charter rate for an Aframax tanker, and this is the cost of bunkers for that tanker at 14.5 knots, roughly, okay? And I just use Rotterdam bunkers. And, you know, until 2008, till the credit crisis, the bunkers cost far more than the ship. And so, you know, in terms of your two main ingredients in your shipping operation, the ship was a very expensive entity, not just in terms of the boom we had, where it was a very expensive entity anyway, but also in relation to the cost of fuel. And for them, we went into a spell where the bunkers were dramatically more expensive. We had a brief change as the bunker prices fell in 15, 16, but we're now back where the ship is less valuable or costs less than the fuel that you use to run it. And that affects the intensity with which you're going to use that ship. And so really, whereas, you know, for 50 years we published Clarkson register with every ship. The only speed we show is the design speed. There was only one speed, and it went, you know, and generally you expected the ship to trade at that speed, say 15.5 knots less the sea margin. When you get into this situation, I'm not sure you can make that assumption because, you know, everybody's, you know, you just do the calculation, and sometimes it's a lot better to go slower and you use your ship less intensively. Now, what has that done to the structure of your balance sheet and your company? You know, it leaves you with a question to think about. At the moment, this is the situation in terms of surplus capacity. This shows you the total gross surplus, which I calculate about 17%. What it means is the fleet's grown 17% more than what I think is a realistic estimate of demand over the period since Lehman Brothers. And so we got this hidden, it's all hidden in slow steaming. We don't have layup this time. In the 80s, we had lots of layup, no layup now, because on the whole, the ships are at sea, but they're going slower, and of course, we can all track them. The relationship here, of course, is, and I'm not going to go through this massively over time, but you know, 20% speed reduction gives you a 50% fuel reduction in fuel consumption. Also, a 50% reduction in carbon emissions. Well, we've got 20%, gives you 50%. In April this year, IMO agreed that the industry was going to cut its carbon footprint relative to 2008 by 50% by 2050. Well, actually, if you reckon that the fleet was flat out in 2008, and today you've got 17% tied up in slow steaming, then the deduction is that you've already made a big inroad into that 50% reduction. And if your slowed down a bit more, you would have made shipping would have achieved its 2050 target tomorrow without worrying about anything else. And of course, not only is that 50% cutting your carbon footprint, it's cutting your sulfur emissions and your particulate matter emissions, because instead of burning 45 tonnes a day, you're burning 20 tonnes a day or 22 tonnes a day. So, I mean, I think there's many ways to skin a cat, is what my old granny used to say. And I think when you look at carbon and emissions, maybe slow steaming is not such a bad thing as it might look. And so that leaves us supply-demand analysts saying, well, what is the surplus? When I run my chart and I've got all that surplus capacity, is that really surplus? Or are all the ship owners really adjusting their book to become compliant, to use less fuel, to optimize a fleet which trades perhaps at a much slower speed? I mean, Maersk began to design the Triple-E's for 24 knots, and by the time they finished their trading, I believe they're probably trading about 17, is my recollection. So, and I think that is an indication of the way we're all having to change the way we look at the future. And I think it's a terrific thing, because it means that shipping can actually, whereas on the technical front, the naval architect can't help you, but the way you trade your fleets can help you a great deal. And that is, the market may not be very good, but you can say, wake up in the morning and say, well, it's a lousy market, but at least I'm helping the carbon footprint, And so there you go. I think that's a good place to finish. Thank you very much, and I apologize.